Okay, the last part of this chapter, the premium tax credit. So I had talked a little bit at the start of this chapter about what the premium tax credit is. It is related to the Affordable Care Act, otherwise known as Obamacare. Part of the Affordable Care Act is the availability for certain qualifying individuals to get assistance. Actually, it's a big part of the Affordable Care Act, to get assistance with their health insurance premiums and paying their health insurance premiums. Now, there are requirements. You have to purchase this health insurance through the healthcare marketplace. So through that website, healthcare.gov, can't remember if that's still the name of it. It has to be purchased through there in order to receive the credit. If you purchase it some other way, or if you get it through your employer or something like that, this does not apply. So it's only those health insurance plans that are purchased through that website. There used to be a penalty for not having health insurance. That has been removed. There is no longer a penalty for not having health insurance. So here's the marketplace. So to receive the credit, because you can also just purchase your health insurance through the marketplace, but maybe you're not eligible for the credit. You can still get your health insurance through there if you can't get it elsewhere. Premiums are really high. They're very, very expensive, but if you don't qualify because of your income, you can still purchase it through there. And in order to qualify for the credit itself, you have to have household income that is between 100% and 400% of the federal poverty level based on the taxpayer's family size. So obviously, federal poverty level for a family of 1 is going to be a lot lower than the federal poverty level for a family of 10. So it's going to be based on family size, not on dependence on the tax return, because you could have a family size that is different from the number of individuals that are claimed on the tax return. So they don't have to be your dependent, but they do need to be included in the family size. So the 400% upper limit, has been eliminated. All right. Through 2025, the 400% upper limit has been eliminated. What does that mean? Taxpayer also has to be ineligible for coverage through an employer or government plan. So even if you are eligible, if you're eligible to get health insurance elsewhere, some subsidized health insurance or even not subsidized, and you choose not to take it, but you go through the marketplace, you don't get the credit if you're going to do that, if you're eligible for other. Taxpayers with income less than 100% of the federal poverty level are generally eligible for Medicaid. So that's where they would get their health insurance. You can apply this credit, like I had mentioned when we started this chapter, you can apply the credit equally over the premiums over the year. So if your premium was $500 and you're eligible for a $2,400 credit over the course of the year, you can apply that $2,400 in the form of a reduction in what you're paying on those premiums. So now you're paying $300 every month rather than $500, because $2,400 over the course of 12 months would be $200 a month. Does that make sense? Or you can take it all at once at the end. Like I said, taking it all at once at the end makes your monthly premiums higher. You're going to have to pay $500 a month, but you don't run the risk of using a credit that you're not entitled to, because at the end of the year you have to pay it back if you don't. Now I don't know if it still applies, but during COVID they made some adjustments to that on that whole payback thing. I'm not sure that still applies though, but because you would have received more credit than you were entitled to, and so it's less risky to take the credit at the end of the year, plus you're getting a bigger chunk all at once. Some people like that, but it means that your premiums are going to be higher, and you run the risk. It means that your premiums are going to be higher on the other side if you apply it on a monthly basis. throughout the year, you run the risk that you're getting too much credit and you're gonna have to pay it back. So this form 8962 is what is filed at the end of the year to reconcile the credit that you received with the credit that you were entitled to. It is a refundable credit, so it acts as a payment. So the amount of the credit is the lesser of the premium for the insurance or the premium for the applicable second lowest cost silver plan minus the amount that the taxpayer contributes. So the second lowest cost silver plan, I don't know if any of you are familiar with the marketplace. I haven't actually been there for a long time to look at it, but they base their plans, they call them, like a platinum level plan is got more benefits, but it's also more expensive. And then a gold level plan, and then a silver level plan, and then a bronze level plan. I don't know, there's like a plastic level plan. but anyway, so this just has to do it, they compare it with the second lowest cost of the silver plan. The cost of these plans is based on where you are geographically in the US too, like even like what county you live in. So the costs are based on all of that. To calculate the monthly contribution amount, the taxpayer will use an applicable figure determined with reference to Table 2, which is in Appendix B. We'll take a look at that here in just a second. Applicable figure is based on the taxpayer's house. Don't you love how they just make it as complicated as possible, right? Based on the taxpayer's household income as a percentage of the federal poverty level for the applicable family size. So here are the poverty guidelines. These are for 2022, so it would be different now. With inflation, I'm assuming these numbers would be quite a bit higher than what they're shown here. But so the applicable poverty level, so for a family of 8, you're looking at $46,630. This is 100% of the poverty level. 400% of this would be times 4. So 120, 130, almost $40,000, right? 6 times 4 is 24 for the 400% of it, right? Which sounds like a lot, but then when you think about the fact that health insurance for a family of 8 could probably run you upwards of $20,000 a month, it's not as much as it would seem. Okay, so let's look at Shantae, married with one dependent, household size of 3. So her household income, so household size of 3, household income is $59,370. This household income is 258% of the federal poverty level for a household size of 3. And how do we get that? Yeah, we're just gonna take her income, or their income, divided by the federal poverty level for a household of 3. That's where we get that 258%, whoops. And then we take that 258% and we apply it to the table, which is in Appendix B. Hello, there we go. All right, so 258 is here. So the percentage, or the applicable figure that they use is 0.0432. So that's where that comes from. I think that's what they came up with on the form. Yeah, 0.0432. All right. So what do we do with that? So the contribution amount equal to the household income, well, we're going to do that, multiplied by the applicable figure from Table 2. So that's how we get that number, and then we'll look at what we do with that number in just a minute here. Let's look at Gordon. Single, no dependents, enrolled in a qualified healthcare plan with an annual premium of $5,000 through the marketplace. His SLCSP, that silver plan premium, which is shown on the form. So at the end of the year, you get these forms. If you're in the marketplace, you get an information form showing who is covered and all of that stuff. This particular form, 1095A, shows what that applicable or that silver plan premium would be. So they tell you what it is. You don't have to guess. You don't have to look it up. $5,200. His household income was $29,900, 220% of the federal poverty level. And they do this by taking his income divided by the number on the chart there, 220%. Then we use the table in the appendix to find out what the applicable number is, which they've shown us here is 0.280. So his contribution amount is $837. So what we do is we multiply his household income by that factor. Okay, so up here where we did this before, it would be 0.0, so 59,370 times 0.0432. Oh, shoot. This thing is so tiny. $25.65. So this is the amount that this family would be expected to contribute. And then the amount over and above that is what they're going to get as a credit, their contribution. Gordon's premium tax credit is the lesser of his health plan premium of $5,000, or I'm sorry, I said that wrong. Health plan premium of $5,000 or $5,200 minus his contribution amount of $837. So this is the amount because this is smaller. So in this case, they didn't give us the health plan premium or anything. What we're gonna do is take this minus what the health plan minus the $5,200. I'm sorry, $5,200 minus the $25.65. Let's just say that their premium is what he actually paid, or what it actually is $8,000. Okay, seems pretty low, but so $5,200 $26.35. And then we're going to take, so the tax credit, the lower of the health plan premium, which up here is $8,000, or $5,200. We're going to assume that her SLCSP cost is also $5,200 minus the contribution of $25.65. So this would be the credit here because it'd be the lesser of these two amounts. So the premium credit is calculated based on expected household income. This is where it gets complicated. When you're doing this and you're figuring out what your premium tax credit is, you do it at the start of the year. So if you're signing up for healthcare, you sign up at the end of the, like maybe right now, for January 1st. And so you have to estimate what you think your income is going to be in 2025. That's hard to do, right? That's hard for most of us to do. So, but you're kind of locked into it. So if you decide to take that credit throughout the year and it turns out that that's not what your income was, maybe you'd be entitled to more credit, maybe you'd be entitled to less credit, who knows, but it's, you know, it's kind of a crapshoot there. So to the extent that actual household income varies from expected, the taxpayer may receive an additional credit or they may have additional tax. If the actual income is greater than expected income, the taxpayer will owe additional tax because the credit decreases as income increases. If the income is less than expected, the taxpayer is going to receive an additional credit. So, and the IRS suggests taxpayers use tax software to file a return because it's complicated. It is complicated. Let's see, did they include the form here? They really didn't, did they? Other credits. There's lots of other credits. These are the major personal credits though. Questions about the premium tax credit? That one's actually a little more complicated than